You probably think having more banks competing for your mortgage automatically protects your wallet, right? You think the free market is your absolute best friend. Well, you are dead wrong. Today, we're diving into a highly rigorous explainer on the Canadian mortgage market, and what the data reveals is going to completely shatter how you view your next trip to the bank.
I want you to really demand the truth from your own financial common sense right now. Does more bank competition actually save you money? We all just naturally assume the answer is yes. More options mean better deals, right? Wrong. Prepare yourself for a massive slap in the face. Relying on market competition to lower your mortgage rate, it's a total trap.
Look at this. This is the reality of human psychology in the financial world. A staggering 45% of new homebuyers visit exactly one lender. Just one. Almost half of all buyers out there just blindly accept the very first offer handed to them. They don't shop around, they don't compare, they are literally volunteering to overpay. And frankly, it's a catastrophic financial mistake. Welcome to the brutal hidden game of mortgages. You walk into a bank and you see the posted rate up on the board, right? The sticker price. Well, let me be blunt. That sticker price is total fiction. It's a starting point for suckers. Your real, actual interest rate is what we call the secret discount. And that discount, it's determined purely by your willingness to fight, haggle, and actually walk away. Because if you don't ask, you definitely don't get. 60%. That is the magic number here. Researchers found massive price differences between different borrowers. And get this, over 60% of that massive price gap cannot be explained by your credit score. It can't be explained by your income or how big your loan is. Over half of your rate is purely about your negotiation skills. It's not about your financial profile, it is entirely about your punch. Section 1. The anatomy of a bank merger. So, to figure out what really happens when banks compete, the researchers acted like financial detectives. They looked at this massive natural experiment where two large financial institutions merged. Think of it like a ruthlessly simple parallel universe comparison. Step 1. They found a local market where two competing banks suddenly merged into one. Step 2. They found an identical market completely untouched by the merger. And step 3. They tracked the money. By comparing these two universes side by side, we can isolate exactly what losing just one competitor does to your wallet. Picture the scene of the crime right before the merger happened. In some local markets, borrowers had 5, 6, maybe 7 lenders to choose from. Then, bam, the merger happens. A giant competitor is swallowed whole. Your choices shrink instantly, and your bargaining power takes a direct hit. So, what actually happens to the prices when the consumer loses their trump card? Well, here is your first piece of hard evidence. When competition dropped, the average negotiated mortgage rate actually went up by 6 basis points. Now, I know 6 basis points might sound absolutely tiny to the untrained ear, but think about spreading that out over a 25-year mortgage on a $500,000 home. That tiny little fraction, it translates to everyday people losing thousands of dollars. The loss of just one single competitor visibly damaged the consumer's wallet. Section 2. Who actually pays more? Here's the secret. Averages are deceitful. Averages lie to us. The real truth isn't found in the average, it's hiding in the extremes. So prepare to have your assumptions flipped completely upside down. The savvy shoppers, the people negotiating incredibly hard for the best rates, they actually saw their rates jump by 8 basis points when competition shrank. They got totally screwed. But the worst negotiators, the bottom 30% who just blindly accepted the highest sticker price, their rates changed by exactly 0. Yep, the savvy shoppers paid the true price of the merger. So why did this happen? It's all about what we call the negotiator's gap. Look, to get a discount, you need a threat. You literally need to be able to look a bank in the eye and say, match this rate or I'm walking across the street to your competitor. When banks merge, that competitor vanishes. Your threat vanishes. When you lose a bargaining chip, the bank wins. Plain and simple. The savvy buyers lost their leverage. The researchers summarize this brutal reality perfectly. Quote, borrowers who are the most adversely affected by a negotiation-based pricing policy do not benefit from an increase in competition. This completely, utterly destroys the myth that a free market automatically protects the uninformed consumer. If you don't know how to fight for a deal, adding 10 more banks to your street isn't going to save you a single dime. Section 3, the competition myth, completely busted. We really need to look at the dark reality of who is actually subsidizing whom in this system. Let's judge the data harshly here. Why didn't the vulnerable, bad negotiators see a price hike after the merger? It's because the banks were already bleeding them dry for the absolute maximum rate. The bank literally couldn't squeeze another drop out of them if they tried. Meanwhile, the savvy shopper lost their leverage and got dragged up. The vulnerable didn't suddenly get a better deal. They were just already stuck at rock bottom. And that led to this stunning statistical quirk. After the merger, the gap between the very best deals and the worst deals actually shrank by 16%. Price dispersion went down. Now, a naive observer might look at that and say, look, the market became fairer. Prices are more equal. Total nonsense. It didn't get fairer at all. The gap narrowed simply because the good negotiators got dragged down closer to the bad ones. Equality in suffering is not a victory, folks. Section 4. Flaws in the formula. Now, even the most rigorous academic studies have blind spots, right? We have to critique the data. First off, this study uses pre-fintech data from 2013. Today, the internet has radically lowered the effort it takes to hunt for multiple quotes. Second, it relies on some pretty unique Canadian laws. Up in Canada, mortgage brokers have a strict fiduciary duty to act in your best interest. In the United States, most brokers do not have that legal obligation. You are entirely on your own out there. Which brings us to the ultimate takeaway of this whole explainer. You cannot rely on market competition to save you. You cannot rely on the government. And you certainly cannot rely on the banks. The data proves it. Financial literacy is your only real armor. Your ability to understand the game, shop around, and negotiate aggressively. That is literally the only thing standing between you and getting totally fleeced. So I'm going to leave you with this provocation. The next time you walk into a bank, which statistic are you going to be? Are you going to be the 45% getting played, blindly accepting the sticker price just because you trust the system? Or are you ready to fight for your secret discount? The data is crystal clear. The choice and the cost is entirely yours.